Welcome to the Coin Bureau Weekly News Roundup. Here are the top stories in crypto this week. Crypto crash continues. Coins and tokens see their largest losses in weeks as inflation comes in hotter than expected and regulators reiterate their desire to crack down. What's next for the crypto market? Everything is a security. Comments by SEC Chairman Gary Gensler confirm that the regulator is targeting every single coin and token besides BTC. Why some are concerned ETH could be on the SEC's radar. Bullish altcoin announcements. Ethereum moves one step closer to unstaking, Anchor partners with Microsoft, and Google becomes a Tezos validator. Everything you need to know. Crypto and geopolitics. Western countries push for strict global crypto regulations while Eastern regions reveal surprisingly pro-crypto rules. Which countries will benefit the most from crypto adoption? Circle taking over. The second largest stablecoin issuer announces plans to increase its workforce by 25% following MasterCard's USDC Web3 payment integration. How will this impact crypto's decentralization? And the one and only Benjamin Cowen tells us what's been on his mind over the last few days. All this and more in just a moment. Good morning, afternoon, or evening. Thank you for tuning in. My name is Guy. This isn't financial advice, and here is the news. Last week, the crypto market took a nasty tumble. The cause of the crash was twofold: uncertainty around inflation and uncertainty around crypto regulation. As a cherry on top, data from the block suggests that the liquidations of leveraged long positions further contributed to the sell pressure. Now, the uncertainty around inflation initially began the week before last, when the Consumer Price Index, or CPI, and the Producer Price Index, or PPI, for January both came in higher than investors were expecting. This is a problem because investors were convinced that inflation would continue its rapid decline. In case you missed the memo, the Fed has been raising interest rates to fight inflation. This raising of interest rates has basically been sucking money out of asset markets as everyone pays down more expensive debts, and investors price in lower corporate profits because of the money shortage. The good news is that the CPI and PPI are still coming down, albeit much slower than before. The bad news is that the Fed's favorite inflation index actually went back into positive territory in January. The personal consumption expenditures, or PCE, rose by 0.1% from 5.3% to 5.4%. This is a bigger deal than you think because it suggests that inflation in the US won't be coming down anytime soon. If anything, it suggests that the US could be on the brink of a second wave of inflation, despite all the rate hikes. Logically, this means the Fed will have to raise rates even higher in response. And that's just the macro side of the story. The crypto side of the story is somehow looking even worse. If you're subscribed to my weekly newsletter, you'll know that I talked quite a bit about the recent announcement by the Fed, the FDIC, and the OCC about volatility in the crypto market. If you watched our video about Operation Choke Point 2, you'll know that the Fed, the FDIC, and the OCC all put out eerily similar warnings in early January. In the weeks that followed, we saw US banks distance themselves from the crypto industry, and regulators like the SEC started to crack down on crypto. The difference is that the recent announcement by these three US agencies explicitly talks about what could happen if there was a run on stablecoins. Now, for context, most stablecoins are backed by US government debt, most of which is held by regulated financial institutions in the United States. When you redeem stablecoins for US dollars, stablecoin issuers sell some of this US government debt to give you US dollars. Now, the announcement explicitly says, quote, "Such deposits can be susceptible to large and rapid outflows stemming from, for example, unanticipated stablecoin redemptions." Now, call me crazy, but this sounds like these US agencies are warning about some kind of upcoming event that could lead to mass stablecoin redemptions. Ironically enough, the only event that could achieve this outcome is a crackdown on stablecoins by US regulators, and it's possible this is what's coming next. To be fair, the recent announcement by the US agencies could just as easily be a reference to the billions of dollars of redemptions we've seen of Binance's BUSD stablecoin after US regulators ordered Paxos to stop issuing BUSD. In 2 weeks, BUSD's market cap has fallen by $5 billion and counting. The thing is that BUSD isn't out of the woods just yet, nor are other stablecoins. That's because it was simultaneously revealed that the SEC intends to sue Paxos, arguing that the BUSD stablecoin is a security. For reference, a security is an asset like corporate debt or a stock in a company, which BUSD clearly isn't. Given that it's also been about 2 weeks since the SEC announced its intention to sue Paxos, the actual lawsuit should be announced within the next 2 weeks as per the 30-day period of the process. It's possible that the SEC's reasoning in its suit against BUSD could be applied to other stablecoins. If this turns out to be the case, then it could lead to the kind of run on stablecoin reserves that the 3 US agencies warned about in their most recent announcement. This seems likely because SEC Chairman Gary Gensler recently confirmed in an interview that everything is a security aside from Bitcoin's BTC. Quote, "Everything other than Bitcoin," Gensler said. "You can find a website, you can find a group of entrepreneurs, they might set up their legal entities in a tax haven offshore, they might have a foundation, they might lawyer it up to try to arbitrage and make it hard jurisdictionally or so forth." Now, the point about crypto foundations is extremely important because most major altcoins have non-profit foundations which coordinate their development, including Ethereum. Some in the crypto community have taken this as a second hint from Gary that he thinks ETH is a security. The first hint Gary gave was back in September when he said that proof-of-stake cryptocurrencies could be securities. He made this comment on the same day that Ethereum transitioned from proof-of-work to proof-of-stake. ETH's price subsequently collapsed by 11%, but Gary's comments were quickly forgotten. Concerns that Gary could be targeting proof-of-stake cryptocurrencies re-emerged after the SEC began cracking down on centralized staking services earlier this month. Kraken was the first crypto company to settle with the SEC for offering staking services, and it's thought it won't be the last that the SEC targets. The catch is that the SEC's crackdown has so far focused on the centralized components of the crypto industry, be they staking services or otherwise. Although this means that centralized stablecoins are at risk, it should mean that decentralized crypto projects like Ethereum will be safe from undue scrutiny. The caveat is that this could change when Ethereum validators are allowed to unstake and claim staking rewards. Take a second to consider that ETH's profile as an asset could radically change after the Shanghai upgrade, at least in the eyes of the SEC. Until then, ETH is still technically a proof-of-work asset. You can find out what the Shanghai upgrade could mean for ETH using the link in the description. Speaking of Shanghai, Ethereum developers recently announced the penultimate unstaking testnet prior to the mainnet upgrade. The Shapelia testnet will be going live early tomorrow morning, specifically just after 4 a.m. UTC. Unfortunately, the date for the Shanghai upgrade has yet to be announced. Now, aside from the possibility that the SEC will see ETH in a different light after Shanghai, the upgrade is otherwise very bullish for Ethereum. A successful upgrade will prove to institutional investors that it's safe to stake and unstake ETH on the beacon chain, which will increase confidence in the project. It appears that ETH has yet to price in the outcome of a successful Shanghai upgrade. This could be due to all the regulatory uncertainty around everything besides Bitcoin. It could also be due to the uncertainty around the possibility that Ethereum validators will sell lots of ETH when they unstake. Regardless, it's clear that institutions haven't completely taken their eyes off crypto. This was made clear by Microsoft's recent partnership with Anchor, a decentralized blockchain node hosting service for cryptocurrency. The partnership will see Anchor provide crypto node services for enterprise solutions. The price of the Anchor token almost doubled following the announcement. What's interesting is that its long-term price history looks almost identical to most other altcoins. It's too soon to say whether this short-term reversal is the beginning of a new bullish trend, but the crypto and macro factors suggest it's not. Note that as impressive as Anchor's partnership is, it's important to remember that relying on centralized servers such as Microsoft Azure for node hosting arguably negates a cryptocurrency's decentralization. If you watched our video about crypto decentralization, you'll know what decentralization really means. As it so happens, Tezos recently announced a similar partnership with Google Cloud. The partnership will make it possible for Google Cloud customers to deploy Tezos nodes and build Tezos dApps. Google has reportedly been interested in crypto partnerships since January 2022 via its digital assets team. Like Anchor, XTZ saw a speculative pump after the announcement. Unlike Anchor, XTZ's longer-term price action doesn't suggest that the coin is about to enter a new bull cycle. This is unfortunate, as Tezos is quite a promising project, but I guess its time to shine won't come around until the next bull market. Make no mistake, however, it's important to take note of these altcoin announcements during the bear market. They are the fundamentals that will take these coins and tokens to new all-time highs when the bull market inevitably comes back. Just be aware of any regulatory risks and any selling by insiders. On that note, don't forget that the world is much bigger than the USA. If your favorite altcoin is declared a security by the SEC, it doesn't mean that it's dead. It just means that it will be indefinitely out of reach to retail investors in the US. While it's true that the US is the largest crypto market, this seems to be changing. If you've watched any of our videos about unelected and unaccountable international organizations such as the Financial Action Task Force, or FATF, you'll know their regulatory recommendations for countries around the world tend to be aligned with and in the geopolitical interests of the United States. Not surprisingly, most of these international organizations have been about as anti-crypto as the SEC. The one that's been making the headlines lately is the Financial Stability Board, or FSB, and that's because it's in the process of putting together recommendations for global crypto regulations. Over the weekend, Indian officials revealed that the FSB's global crypto regulation recommendations will be the precursor to a so-called synthesis paper. It will be published in partnership with another American-affiliated international organization called the International Monetary Fund, or IMF. This upcoming synthesis paper seems to have its roots in the IMF's recent realization that crypto's purpose is to compete with and eventually conquer the traditional financial system. This is code for displacing the US dollar as the world's reserve currency, which of course the USA does not want. Now, when the FATF, FSB, IMF, or any other international organizations announce that some kind of global regulations are in the works, then countries around the world typically wait and see what they are before implementing regulations in their regions. However, this doesn't seem to be the case with crypto. Last year, the EU announced its finalized crypto recommendations, and the final text should be released sometime next month. Earlier this year, the UK released its own upcoming crypto regulations. In both cases, the crypto regulations are abnormally pro-crypto, in stark contrast to the United States. More recently, Hong Kong announced that it will be allowing institutional investors to get exposure to crypto sometime in the summer and may allow retail investors to follow suit. According to Bloomberg, this pro-crypto stance was not so subtly approved by officials in mainland China. This announcement led Gemini Exchange co-founder Cameron Winklevoss to speculate that the next crypto bull run will begin because of East Asian investors. Other crypto analysts pointed out that pro-crypto regulations in Asia will also attract lots of crypto companies and crypto projects. Taken together, these announcements suggest that countries aren't nearly as keen to follow the United States' lead on crypto regulation. The fact that this list includes countries that are generally considered to be close allies of the United States underscores the extent to which geopolitical rifts are forming. It also highlights the fact that any country that decides to defy the US on crypto regulation stands to reap massive rewards, and any country that complies with the US's crypto regulations will quickly be left behind, including, of course, the US itself. In other words, the global competition for crypto adoption has begun. The United States is hyper-aware of this new geopolitical tug-of-war, and it happens to have a secret weapon up its sleeve that's been hidden in plain sight. This weapon is a crypto company with close ties to the Fed and the largest financial institutions on Wall Street. This weapon is Circle Internet Financial. If you watched our video about the company taking over crypto, you'll know that Circle has been making mad money during the bear market. Recall that most stablecoins in circulation are backed by US government debt. Well, the interest rates on this debt have gone up as the Fed has been raising rates. This means that Circle has been making billions in passive income from its USDC reserves, while every other crypto company and project has been getting wrecked by these higher rates. And while these companies and projects have been cutting their headcounts, Circle wants to increase its own by 25%. At the same time, USDC's use within the crypto ecosystem has been increasing. This is thanks to the integrations that the stablecoin issuer has been able to secure with legacy payment institutions such as MasterCard, which recently made it possible to settle payments at merchants online using USDC. Circle's exponential growth has even led Ethereum creator Vitalik Buterin to voice his concerns that USDC could decide future Ethereum forks. This is simply because centralized stablecoins like USDC are of paramount importance to Ethereum's ecosystem, especially in decentralized finance protocols. So, what happens if US regulators crack down on all the other stablecoin issuers and leave Circle's USDC as the last man standing? Well, in short, it would mean that the US government would essentially have total control over the crypto ecosystems which leverage USDC, which is all of them. The scariest part of this possibility is that ensuring USDC is the only stablecoin standing is in the strategic interest of the US, given the supposedly pro-crypto stance of many of its geopolitical opponents and allies. The only way the US could retain control of the crypto industry in these circumstances is through USDC. But again, that would require getting rid of every other stablecoin that's out there, or rather, getting rid of every stablecoin issuer that can't be adequately controlled by US authorities. There will still be other stablecoins for other fiat currencies, but the US would probably want all of them to be issued by Circle. Now, I'll reiterate that this all assumes that crypto is becoming a part of the geopolitical game. It certainly looks like it is, but some would say this evidence is circumstantial. Well, since I'm already speculating, I'll give you one more possibility to ponder when it comes to stablecoins and geopolitics. Coinbase recently listed Circle's Euro stablecoin on its exchange. Like USDC, EuroC is presumably backed primarily by European government debt. The difference is that there are many different countries in the Eurozone, and that means each government has its own debt, so to speak. Anyone familiar with the Eurozone will know that the European Central Bank must be very careful when it raises interest rates because some countries in the Eurozone can't handle these rate hikes. EuroC could make it possible to subtly support these weaker countries by buying their government debt. If the Fed is raising interest rates to squeeze its geopolitical rivals, having Circle create stablecoins for friendly countries would make it possible for them to raise interest rates too without defaulting. BlackRock could buy up their stablecoins with borrowed money from the Fed to prevent this outcome. That really would be something. And with that, it's time for Ben Cowen's peerless crypto analysis. Take it away, Ben.
Hey Guy, thanks for having me. Pleasure to be here as always. Today, I wanted to show an interesting way to look at the price of Bitcoin, and that's of course via the extension from its 20-week moving average. I call this the short-term bubble risk. And the point of measuring Bitcoin's price in this manner is it can help us identify when the asset is very hot and likely due for a pullback, or very cold and due for a bounce back up to the upside. Now, what you'll see here are color-coded regions that go from dark blue to dark red. Of course, the colder the color, so your the light blues and the dark blues, mean we're generally below the 20-week SMA during that time. And when it's in the hotter colors like yellow, orange, and red, it means we're getting further and further extended from the 20-week SMA. And what you'll notice is that our bear markets that we experience, we spend a generally long amount of time below this 20-week SMA. You can see that occurred over here in 2014. It also occurred in 2015 as well, in 2018 as well, and then more recently in 2022. Another way to visualize this is to just isolate certain levels. So you could isolate anything below zero and show where that is on the chart. And when you look at it like that, you can clearly see the bear markets of Bitcoin. But one of the ways that I like to look at this is to only visualize when it's greater than 100% extended from its 20-week moving average. One of the things you'll notice with Bitcoin, anytime it gets to being above 100% extended from the 20-week moving average, it is normally meant a sizable pullback is coming in the not so distant future. And you can see we reached that point during the first peak of 2021, but of course not the second one. A lot of the metrics had time to adjust, and that's why the first peak still remains, I think a lot of people's mind, the main peak sort of measure against when thinking about when was the actual mania phase of this last cycle. And of course, the extension from the 20-week SMA is something else that sort of cements that this was a more manic phase than what occurred later on in 2021. You can also, of course, add the 75 to 100% extension from the 20-week moving average and see how sometimes we sort of slowly build into the mania phase, and then other times we just go straight into it, spend a few months up there, and then we just go back into a bear market, which is what you'll often see following these major extensions from the 20-week moving average. Another asset that we can look at this for is Ethereum. And I mean, I know a lot of people are very interested in Ethereum, and you can see a very similar type of pattern here. Whenever you see these large extensions from the 20-week moving average, say of 100% or so, it certainly means the asset is getting relatively heated, and you are likely going to see some fairly substantial pullbacks in the not so distant future. You can also look at this too, as we did with Bitcoin, when you look at it when it's below its 20-week moving average, and then better identify where all the bear markets are occurring, of course, for this asset. The last thing I want to take a look at is just the total market cap, because rather than isolate any individual cryptocurrency, we might as well just look at the whole market, or look at the market as a whole. Once again, the bear markets are pretty easy to identify, but what you'll also notice is that when you come out of bear markets, you can still spend some time in relatively dull phases for often a year or so before getting into a true mania phase. And that's generally why I think what a lot of us are expecting this time around as well. Not for it to be that drastically different from what we've seen before, but in general, just a long recovery year for Bitcoin, where it's likely going to chop portfolios up both to the upside and the downside for the next year. But hopefully by the next halving, we can turn things around, which might coincidentally also correspond to a timely pivot by the Federal Reserve and a pivot hopefully back to quantitative easing. Hopefully this was insightful. Thanks for having me again. Pleasure to be here as always. I'll see you again next week. Bye.
Thanks, Ben. This Thursday, Ben, Rob from Digital Asset News, and myself will be going live on Coin Bureau Clips at 9 a.m. Eastern Time. That's 2 p.m. GMT. You'd be mad to miss it. And that is all for today's Coin Bureau Weekly Crypto Review. If you enjoyed it, you know what to do. Hit that like button, subscribe button, and bell icon too. If you're looking to maximize your gains during the bear market, the Coin Bureau Deals page is where you should go. You can find the link to that resource and many others in the description below. Thank you so much for watching, and I will see you all in next week's episode.